So imagine a crypto project that seems to have everything going for it. I mean, it ticks all the boxes. No VCs getting in early, listings on all the major exchanges right out of the gate, and a pre-launch value of over $500 million. It sounds like a surefire recipe for success, right? Well, with a project called Katana, the reality of its launch day told a very, very different story. Okay, let's just break this down because this slide really gets to the heart of the Katana paradox. On one side, you've got the promise. We're talking a fair launch, no venture capitalists getting special deals, instant access for everyday traders on giants like Binance and Coinbase, and a whopping $500 million in pre-launch value. I mean, picture perfect. And then you have the reality, a massive, brutal price crash almost the second it went live. And that's the million-dollar question, isn't it? It's what every trader who watched this unfold was asking. How could a project that looked so perfect on paper crash so hard, so fast? Well, let's get into it. First up, we're going to peel back the layers of this launch day mystery. What really happened in those first few hours? But to really solve that mystery, we first have to understand what Katana actually is. And that brings us to its core engine, what they call the DeFi flywheel. The key word here, and it's an important one, is opinionated. See, Katana isn't trying to be another everything chain. It's an Ethereum Layer-2, which just means it's built to make Ethereum faster and cheaper. But it is laser-focused on one single thing, becoming the #1 place for DeFi liquidity. It's not for general use, it's a specialist, built for a specific job. And this specialized approach is exactly what got everyone so excited. First off, it's got some serious muscle behind it, backed by heavyweights like Polygon Labs and GSR. Instead of letting liquidity get spread thin across hundreds of different apps, it focuses all that activity into a few core, trusted protocols, like Sushi and Morpho. Its main mission is to fix one of DeFi's biggest problems, fragmented liquidity. But the real kicker? That last point. No VC rounds, no insider unlocks. This was sold to everyone as a truly fair launch. And this is how that engine is supposed to work. It's designed to be this self-fueling cycle. So step 1, you stake your CAT tokens. In return, you get something called vKAT, which is basically your voting power. Then, you use that power to vote on which liquidity pools get rewards. The pools that get the most votes attract the most liquidity, which in turn generates more trading fees. And here's the best part. A slice of those fees goes right back to the people who staked their tokens in the first place. See? It's a loop, designed to create a sustainable yield. So, with those strong fundamentals and that clever economic model in mind, let's get to the main event. Let's perform an autopsy on that massive price dump. Just look at that number. Over a third of its value gone in a flash. Despite what looked like a perfect setup, Katana's token price collapsed by almost 37% right after it hit the big exchanges. So, how on earth did it happen so fast? Well, this was a textbook sell the news event, but kind of on steroids. It all kicked off on March 18th, the day of the token generation event, or TGE. The second the token hit the exchanges, the airdrop recipients, these are people who got the tokens for free, they started selling. I mean, why wouldn't they? Any price is pure profit. Then, the early buyers from the public sales also decided to take their profits. And the result? Just a massive wall of sell pressure that sent the price crashing from about 1.8 cents all the way down to under a penny in just 2 days. And hey, don't just take my word for it. As market analysts pointed out, this wasn't some huge surprise. It was a classic, if pretty brutal, case of post-launch profit-taking. The hype builds up, the price pops on listing, and then all the early folks cash out. But believe it or not, the story didn't end with that crash. What came next was a period of extreme, almost chaotic volatility. It was a wild ride. And this is where things get really, really strange. Just look at this chart. On one side, you have Katana's market cap, the total value of all its tokens, at just under $24 million. But then, look at the other side. The 24-hour trading volume exploded to nearly $98 million. That is a massive disconnect. So what's the big deal? Well, this creates a 4-to-1 ratio of volume to market cap. To put that into perspective for you, most big established cryptocurrencies have a ratio way, way lower, like between 0.1 and 0.5. A 4-to-1 ratio means the equivalent of the project's entire value was traded almost 4 times over in a single day. This usually signals one thing: intense distribution, or in simpler terms, massive large-scale selling. And just when you thought things couldn't get any crazier, boom, this happened. Completely out of the blue, South Korea's biggest exchange, Upbit, listed Katana. The result? A sudden, whiplash-inducing 55% pump in the price. It was a pretty stark reminder of just how event-driven and wildly unpredictable this token's market had become. So for anyone trying to trade this chaos, analysts are keeping a close eye on a few key levels. That 0.0095 mark, that's the critical support level. It's the floor that was set right after that big crash. Then you've got the zone between 0.0125 and 0.0130, which has basically become a giant wall of resistance. And finally, that 0.018 level, the one it hit during that Upbit pump, that's pretty much the top of the current trading range. All right, so after all of that chaos, we have to ask the big question. Where does Katana go from here? Is this whole thing an opportunity, a trap, or maybe something else entirely? And this really brings us to the great Katana debate. You've got two camps. The bulls, they'll point to those strong fundamentals, that truly fair launch with no VCs, and the huge potential of that DeFi flywheel we talked about. But the bears have a pretty strong case too. They see the extreme price risk, a model that, let's be honest, is still unproven, and that constant threat of more profit-taking from early holders. But at the end of the day, it all comes down to this. The drama of that first day, that launch candle, it doesn't define the project's future. The real test is whether Katana can turn all this speculative trading, all this exchange liquidity, into something real. We're talking sticky users who stay, sticky TVL, value that stays on the platform, and real, genuine activity. That is the challenge ahead. Which leaves us with one final big question to think about. Is Katana's fair launch model a revolutionary new way to do things in crypto? Or did it just concentrate all that early selling pressure onto the retail traders who bought in at the launch, creating a new, maybe more democratic, but equally high-stakes form of risk? That's something the market is still trying to figure out.